Jonathan Garner, Chief Asian and EM Equity Strategist at Morgan Stanley, joins us right now on the show from Hong Kong. Good having you, Jonathan. Thanks so much for taking the time out. 5 years after the great financial crisis, how would you describe the mood back then amongst investors as the US economic machinery came to a standstill compared to right now?
Well, most of the indices that we followed moved to exceptional levels. Both price, fund outflows, investor sentiment surveys were at really extreme levels. On price momentum, for example, we had a 3 standard deviation event versus 50-day moving average, spot to 50-day average. So that was really an extreme, sudden, bearish realignment. What we've been going through the first half of this year is more of a sort of a grinding process of working through the issues in Europe.
Right. How would you compare what we are seeing in the markets right now to what happened earlier, especially in the Asian markets?
Well, it's very different. Valuations are low in Asia. They're depressed to history significantly and backtest well for returns 6 months out. They're not as extreme valuations as what we saw in the global financial crisis, because at that point, in the third and fourth quarter of 2008, we were looking at trends in industrial production, economic activity that were really hadn't been seen since the early 1930s. This is a global economic slowdown, but it's a long way from a recession. We're still forecasting global GDP growth around about 3.5% and emerging markets GDP growth 5.7%. That's a very different environment this time around.
We've seen QE1, QE2, Operation Twist from the Fed. Was it the right thing to do, given its impact on Asian equities? What do you make of the policy stance?
I'm really not a fan of looking at Asian equities through the lens of monetary policy set outside of Asia. We saw an enormous policy decoupling in 2009. It was the first time that Asia showed policy independence on the fiscal side, launching the fiscal programs, the interest rate reductions and other monetary support mechanisms. It meant that Asia had its economic recovery before that of the United States and Europe, and throughout this recovery, Asia and EM has been growing far more strongly, accounting for about 80% of global growth. So I think a lot of the action that will support Asian equities will be taking place here in Asia, and in particular the China rate cut is extremely important.
Is a QE3 overdue, you think?
Well, we thought some form of QE3 was likely. Instead, they went for an extension of Operation Twist, but actually left the door open to do QE3 later on. I think the main mechanism for Asia is in relation to currency weakness. If it allows the dollar to weaken a bit, that would be marginally helpful to Asia, but it's not of any great significance versus the self-help that's ongoing in relation to policy out here.